When markets get choppy, investors can pull out to save their money, or they can cast their lines for discounted stock, aiming for a bigger profit later on. This second option is called buying the dip, and it's been a popular strategy in the markets for years now. It was even touted during the crash of 2008.
This is not a time to be selling your stocks. It's times like these where people really make money because stocks become a better value.
But so far in 2022, buying the dip hasn't paid off as well as in the past. Markets are volatile, and in this environment, buying the dip can be risky.
What we're seeing is that after people step in to buy the stock market dip, the S&P 500 has kept falling the day after. So that means that you're sitting on a loss pretty quickly.
But even these circumstances haven't stopped investors who want to bring in a big catch. Here's why it's such an attractive strategy, but nearly impossible to time. Let's zoom out. Buying the dip is when investors purchase assets after they have dropped in price on the assumption that their value will bounce back.
What we've seen over the past few decades is that sharp downturns in the stock market have often been followed by these huge rebounds. So people that have sat on the sidelines during, say, the financial crisis or the March 2020 COVID crash have watched stocks kind of go up after those instances.
Investors willing to dive in tend to have one of three main motivations. First, some investors want to buy into growing companies. They care less about the price of the stock and more about the opportunity to reel in a company they think will experience significant growth in the future. Other investors look for stocks with upward momentum, meaning rising prices. They're most interested in timing the bottom of the dip so they can maximize profits. And then there's investors who want cheap stocks. They don't care as much about how fast and how far their stocks will grow, but they're excited that stocks that were previously expensive are now cheap enough for them to grab. Mainly, they think the stocks they're buying will keep going up. Whatever their motivation, if a lot of investors attempt this strategy, the result can have another effect. One that has played out in the past few years as more individual investors have entered the market.
Individual investors have become such a prominent force in markets in recent years. They've stampeded into the markets. They've bought a record amount of stocks. So some analysts and strategists do say that they can kind of provide a backstop to the market and help support the market during volatility.
Sometimes, when enough investors try to catch cheap stocks, they can actually reverse the downward trajectory. Take, for example, the 2008 crash after the housing bubble burst. It sent markets into a tailspin. But by 2009, many investors began re-entering the market, pushing up the prices of cheap stocks.
Investors halted a 3-day losing streak, sending stocks broadly higher on a weaker dollar and better than expected home sales numbers.
It was known as the 2009 dash for trash.
We saw that prolonged downturn, that steep sell-off was followed by an incredible recovery, an 11-year bull market for stocks.
The MSCI All Country World Index ended up returning its best annual performance on record in 2009, just after its worst performance in 2008.
People who said, the stock market is too scary for me right now, they missed out on those mammoth gains and may have regretted it.
Strategists say that since then, investors have been conditioned to buy the dip. And it's made individual investors money, at least until 2022. Since the Federal Reserve has made the biggest interest rate increase since 2000, some think a recession is ahead.
This is a huge shift for financial markets, and that's one of the key reasons we've seen this volatility.
It's an example of why it can be so hard for investors to time the dip, because stocks can keep on falling. Vanda Research estimates the average individual investor portfolio peaked late in 2021 and then tumbled, losing an average of about 28% by May 9th. With all the dangers associated with buying the dip, it's no wonder that analysts consider it risky.
If you choose to buy the dip, you can't expect the market to bounce immediately. It could take days, weeks, months, or even years for it to rebound and for you to pocket a profit on that trade.